Hello and welcome to another edition of Accounting After Dark. This is Kieso Weygandt 17th edition, problem E or exercise E412. So we're given here this company, Zambrano Corporation, and then we're given some additional information over here about some various different prior period adjustments or the like. And we're basically asked to go through and prepare a statement of retained earnings for Eddie Zambrano Corporation. And then we're also being asked over here to do a basically like kind of an appropriated retained earnings. So before we start with this, I think it's kind of important to remember what is the function of the statement of the retained earnings. If we remember back from financial accounting, what it is it's essentially the link between the income statement and then the balance sheet. And the way we would do the statement of retained earnings before is we would start with our beginning retained earnings. Okay, we would be adding in our net income. We would then be subtracting out over here our dividends. And this would be giving us here our ending retained earnings. Now, one of the things going back to financial accounting is when we were going through and doing this, more than likely, when we were looking at retained earnings over here, we weren't necessarily as concerned with the income tax effects. However, when we're looking at net income now, and this is especially true in intermediate accounting, we're going to have our revenues minus our expenses. It gives us our net income before income taxes. We're going to have our tax rate, and this is going to give us our net income after tax. And this here in intermediate accounting is what is ultimately going over here into our statement of retained earnings. So when we look at the statement of retained earnings from an intermediate accounting standpoint, we have to be really careful here that this balance here kind of like essentially that we're showing these balances or these adjustments net of tax. Now, one of the things I do like about this problem is it's pointing out some things here about prior period adjustments, cumulative decreases in income from a change in inventory method, dividends declared, and we'll kind of get to that in a moment, but it's dealing with some things over here that we are going to actually make adjustments with retained earnings. Now, the important thing to remember is that if we're showing numbers over here for 2020 in our income statement, the investor is looking at this, or the investor or the third party that's reviewing these financial statements, they're kind of thinking right here is like, okay, this information relates to 2020. So if there were errors or there was mistakes in prior period adjustments, we can't really adjust the current period numbers because that would not make those comparable with other years. So instead, what we're going to be doing is when we look at our beginning retained earnings, we're going to make some what we call prior period adjustments. So let's take it over here. So we've got Zambrano or Eddie Zambrano Corporation statement of retained earnings. And this would be for the year ended 12/31. 12/31/20. So we're going to start here with our beginning retained earnings, right, as of 1/1/20. Now, what this is doing over here is that this is showing us over here net income and dividends declared. One of the things about net income, though, is I'm assuming that this is going to be net income after tax because this is saying over here income before tax. So my beginning retained earnings is essentially going to be, well, if I started business on January 1st, right, my beginning retained earnings was 0 plus my net income minus my dividends. That was basically my 2017 ending retained earnings balance. For 2018, this is my beginning plus my net income minus my dividends, okay? And what's really key here with dividends, it's about dividends declared. It does not matter if they're actually paid, if they're actually declared, that's the important part. So now here at the end of 2018, my ending balance in retained earnings is 115,000. Let's just make this a little bit easier on ourselves, and let's kind of go through and do a little trailing here. So let's see here. So in 2017, my beginning balance was 0, right? Because I began operations on January 1st. My net income over here was going to be $40,000. My dividends for 2017, according to the problem, are going to be 0. So my ending retained earnings is my beginning plus my net income minus my dividends, or 40,000. When I get to 2018, my ending from 2017 becomes my beginning for the following period. And then I'm shown over here for 2018, I had net income over here of 125,000. And then over here, I had less my dividends declared of 50,000. So my ending retained earnings over here is going to be $115,000. Now I get to 2019, my beginning is my ending from the prior period. I'm adding in 160,000, which was my net income for 2019. And then I'm going to go ahead and subtract $50,000 right here. So my ending retained earnings is going to be $225,000. So that's how I'm coming up with this number that is right here. So my beginning retained earnings, okay, as of January 1st, 2020, is going to be my ending as of December 31st, 2019, or $225,000. Now, the one thing about beginning retained earnings is before I get to net income and dividends for 2020, I have some issues. My first issue here is that I understated depreciation expense by $25,000, okay? So I didn't take enough depreciation expense. So what I'm going to need to go through and do is to make an adjustment here to reduce my beginning retained earnings for this error. Now, what's really important here is that you see this is before taxes. These numbers here for net income, these were after tax. So what I need to do here for this prior period adjustment is I'm going to have to make an adjustment, or I'm going to have to show it net of tax. So what I'm going to do here is I'm going to say here, prior adjust, or prior, basically, or I should just call this here, called prior period adjustments. And what I'm going to do here is I'm going to show over here understatement of, wow, Tchaikovsky, great spelling, of depreciation expense, okay? And this is going to be net of blank tax, okay? So what I need to do with this particular one right here is that, all right, the amount was $25,000 before tax. What was this amount after tax? Well, $25,000 is pre-tax, okay? My tax is going to be 20% of the $25,000. So my after tax here for this adjustment is going to be 25,000 minus 5, or $20,000. So right over here, I'm going to write net of, and this is going to be over here, this is going to be $5,000 tax. So this is how I'm coming up with this number right over here. So that's my first prior period adjustment. And this is going to be a negative amount because I didn't record enough depreciation expense. Again, it's an understatement. I didn't record enough. If it was an overstatement, I would be adding it back in because I took too much. Remember, depreciation expense is going to be reducing my net income, or basically my operating income. So what I need to do here, I didn't take enough, so I need to subtract some more out. So the next one I have here is a cumulative decrease in income from a change in inventory methods. Again, this is not something that's going to be showing up when we're going through and doing the 2020. This is a cumulative decrease. I changed from FIFO to LIFO, or I made another change. And as a result of this change, I've got a cumulative decrease in income. So my income is decreasing. So what I need to do is to make a similar adjustment showing net of tax. So this here will be cumulative decrease in income from a change in inventory methods, net of blank tax. And so what I'm going to do over here is similar to what I just kind of showed over here, is I'm going to take here, I've got this here, this is going to be 35,000. My tax, so this is my pre-tax, okay, and this over here is the change in inventory methods. This is my depreciation understatement. Over here, this is 35,000 pre-tax. The amount of my tax is going to be 20% of this amount. So my amount after tax is going to be $28,000. So I have over here minus $28,000. Okay. And when I'm showing this, when I'm netting it of tax, I need to show the reader that, hey, this is net at $7,000 tax. Very, very important to reflect that. So the reader knows that, in fact, that this is not, I'm comparing apples to apples. Remember, these beginning retained earnings amounts already have taxes deducted. Over here, these amount are before taxes. And so if I'm comparing these numbers here, they need to be shown net of tax. So my beginning retained earnings balance as of 1/1/20 adjusted is going to be 225,000 plus minus 20,000 minus 28,000. So now I'm ready to move on. So my next one over here is so I've dealt with this, all this information up here is helping me with my beginning retained earnings balance. Now I'm ready to look at my income before income tax. So this is income before income tax. Normally when I'm going through and doing this, I've got my beginning retained earnings plus my net income. However, as we were saying before, this is now net income after tax. This is net income before income tax. So what I need to do is to make a similar adjustment. So over here, I've got net income, right? Basically, so my pre-tax here is 240,000. Okay, I'm gonna have my tax, which is gonna be 20% of the amount. So after tax, it's gonna be 192,000. So over here, I'm gonna say net income. I'm gonna put in here 192,000. Now notice over here, it's kind of, I'm not saying net income net of blank tax because it's already implied. I'm implying over here by putting in this net income that I don't need to say net income after like net of tax, just because over here, again, this is coming directly from my income statement where it's already kind of that implication is already there. The next one over here is dividends declared, okay? And with dividends declared, remember with dividends, right? The key thing here is the way I go through and I record dividends is that with my dividends account, and I love my T accounts because I'm Tchaikovsky and I can never get enough of the T's. Okay. So when I was going through and when I'm recording dividends, the way that I'm going to be going through and recording dividends is I'm going to be basically debiting dividends. I'm going to be crediting dividends payable, okay? So it doesn't really matter if I'm paying the cash out in the future. What's going to happen here is once I've declared the dividend, it will be reducing my retained earnings. So right over here, this is going to be less dividends. Okay, and this is going to be less $100,000, and I do not need to worry about the tax implications for the dividends. And so then over here, my ending retained earnings is going to be this balance right here, my adjusted beginning balance, plus my net income, less my dividends, or a total of $269,000. So that is going to be my ending, that will be my ending retained earnings balance. Now, so that's kind of what we're doing here is a few different things from accounting 1A, but essentially it's the same, it's relatively the same process, just with a couple different twists. So the next one here is that assume Eddie Zambrano Corporation restricted retained earnings in the amount of $70,000. Okay, and this is when we're starting to talk about appropriated and unappropriated retained earnings. And this is something that's going to be done by a board action. Okay, so right over here, and it essentially can just restrict the use of those retained earnings. It may make it not able for essentially for a dividend to be paid out. But again, they can be restricted for various different reasons. Have I ever seen that in my accounting career? No, but it's more of like an academic exercise. So my total ending retained earnings is $269,000. And over here it says, assume that Eddie Zambrano restricted it in the amount of $70,000 as of December 30th, 2020. After the action, what would Zambrano report as retained earnings in its balance sheet? And so what you would be doing here at this point is what we're going through is we're saying, okay, my total retained earnings is still going to be $269,000. However, it's going to be made up of two different components. It is going to be made up of appropriated retained earnings, and this is going to be $70,000 appropriated. Same thing as saying it's restricted. And then the difference over here, or 269,000 minus 70,000, is going to be the amount of my unappropriated retained earnings. Okay, and unappropriated means it's free, meaning it's not necessarily that it's free, but that it's one of those things where that it's essentially going to be, let me find this over here. So what unappropriated means, it means it's unrestricted. And again, these are going to be actions that are going to be taken about board, and it's essentially, the book gives the explanation for it, is that essentially you're still going to be showing total retained earnings as $269,000. If you are appropriating a certain amount of retained earnings for whatever reason, it just means that I cannot pay dividends out of this amount. It's not available for dividend distribution. This will be done by, say, like by a board action. So again, and it's up to, remember, with a dividend, it is not mandatory. It is up to a board of directors to go through and issue it. I can show you plenty of corporations that have a lot of retained earnings, like Home Depot, tons of retained earnings. It is not required to give out a dividend. So that's how we would basically go through and show the second part right over here. Total retained earnings does not change. It's just this designation right here. If I'm an investor, though, and if I see appropriated or unappropriated retained earnings, I may be asking the question to manage or to the board. It's like, what are you guys doing? Again, I've never seen it before. I've seen a lot of publicly traded companies, but again, there might be something beyond academia where this actually goes through and happens. However, I think it would be raising a lot of concerns with investors. So I want to thank you for joining me here today on this continuous accounting adventure. This was exercise 4-12 of Kieso, 17th edition unlisted, Accounting After Dark, and hope to see you on the next video. Have a great one.